As many of you know, the Fidelity Global Quality Income ETF has been a long-time favorite of mine. In fact, it currently makes up a massive 40% of my portfolio. But after some serious reflection and a fresh look at the data, I have to be honest with you. I'm no longer 100% convinced that this fund belongs as a core holding. A major restructure is now planned. I'm not panic selling, but I am changing my strategy. Today, I'll show you exactly what my portfolio looks like right now and why I've decided to stop adding to my largest position. As always, this is not financial advice, just my own opinions and experiences. All right, let's dive straight in. Here is how my portfolio looks at the moment. The heavyweight is, of course, the Fidelity Global Quality Income ETF. For a long time, this was my gold standard. It picks high-quality companies, and for a while, the dividends grew every year, even in 2020 during the pandemic, which I found amazing. However, since 2023, the payouts have started to struggle. The growth has stalled, and this year isn't looking much better. The February payout was actually lower than the previous years. While the total return is impressive, a yield of barely 2% with falling dividends is a red flag for an income-focused investor. I want reliable cash flow, not just a green chart. Number 2 is the SPDR S&P US Dividend Aristocrats ETF. Unlike Fidelity, this fund is the definition of stability. The total return hasn't been impressive recently, but I love this ETF anyway. With a 7% annual dividend growth rate, this fund stands out as one of the best dividend growers on the market. The next one is the iShares MSCI World Quality Dividend ETF. Even though its selection criteria are simpler than Fidelity's, it holds many of the same companies. In this 5-year total return comparison chart, we can see that both ETFs have performed exactly the same. But here's the kicker. The dividends are performing better right now. It offers a higher yield and much more stable payouts. Overall, this fund is very similar to the Fidelity ETF, which gives me another reason to decrease Fidelity's share. I've also recently added the Vanguard FTSE All-World High Dividend Yield ETF and the iShares World Equity High Income ETF. The latter, WINC, is my income booster, a covered call ETF with a massive yield. Right now, the current yield of the entire portfolio is 2.5%, which is ridiculously low. My goal is to get Vanguard to 20% and WINC to 10% of my total holdings to boost that yield. But there is still a quality gap in my portfolio that Fidelity isn't filling anymore. So, how do I fix a 40% Fidelity position without selling and triggering taxes? I stop adding to it, for now. I'm letting Fidelity naturally drift down to 15% of my portfolio by diverting all my new capital into Vanguard, WINC, and a brand new position, the L&G Global Quality Dividends ETF. But why the L&G ETF? We have discussed it a lot on this channel, and it seems perfect. It invests in quality companies, provides about double the yield of the Fidelity ETF, pays out monthly, and reduces my U.S. exposure. This is how my target portfolio will look. I really like this setup. And as you can see, the dividend yield looks much better already. Of course, for many of you, that yield is still way too low. But for my strategy, it's just fine. I don't need to live off my dividends right now, as I still have some time to keep accumulating. And since I expect some decent dividend growth over time, the yield on cost should naturally increase over the years. By the way, we've discussed all these ETFs in earlier videos, so feel free to check them out. I've linked them in the description below. Another plus for this new strategy is the dividend calendar. Now, cash flow is arriving several times each month. In fact, there are 32 payouts throughout the year, which I find amazing. Now, let's quickly evaluate the portfolio. The strengths are clear. It primarily holds quality stocks that tend to grow in both price and dividends, and it provides that consistent monthly cash flow. The downside? There is still significant U.S. exposure. I'm fine with that, though, and the current dividend yield could be higher. But I want to hear from you. Am I being too harsh on Fidelity? Or is 40% in one ETF simply too much for any portfolio? Let me know your thoughts in the comments. Thanks for watching, and I'll see you next time.